You've been watching the cocoa market over the last year, you know it has been an absolutely wild ride. Welcome to this explainer breaking down Guan Chong Berhad's latest Q1 2026 interim financial report. Today, we're putting on our equity research analyst hats to look at exactly what's happening under the hood at one of the world's largest cocoa processors.
So, let's dive right in and decode what is really going on beneath the surface of these numbers. For us Malaysian retail investors, just glancing at the headline figures of an earnings report rarely tells the whole story. You've got to understand the mechanics of the business, the macro environment, and how management is actually steering the ship. And right now, well, GCB is navigating some incredibly fascinating crosscurrents.
We're going to answer the central question on literally every investor's mind regarding the sustainability of their recent profits. Is Guan Chong genuinely benefiting from a long-term structural shift in the market, or are their current earnings just kind of an illusion, boosted by temporary price distortions and accounting tailwinds? By the end of this explainer, you're going to have a rock-solid framework to evaluate exactly where they stand.
Section 1. The Q1 Profit Paradox. We start off by looking at an absolute financial paradox that honestly might leave you scratching your head at first glance. Look at this. GCB's revenue absolutely plummeted by nearly 40% year over year, dropping down to 2.62 billion ringgit. Yet their profit before tax surprisingly jumped almost 28% to 150.8 million ringgit. Now usually, when a company's top-line revenue falls off a cliff, the bottom-line profit goes right down with it. So how on earth did GCB make substantially more money while bringing in drastically less revenue?
Section 2. The Cocoa Price Roller Coaster.
You simply cannot understand 2026 without looking back at the sheer chaos of 2025. Throughout that year, the cocoa market was just incredibly volatile. In Q2, prices hit these extreme, unprecedented peaks, which led to intense consumer pushback. Basically, chocolate just got way too expensive. By Q3, manufacturers kind of panicked. They started altering their recipes, swapping in cheaper substitute ingredients instead of using real cocoa. Then, in Q4, cocoa prices finally started to fall back down to earth, but demand remained soft because those manufacturers were still burning through all that substitute-heavy inventory they'd built up. Finally, entering Q1 of 2026, we're seeing prices stabilize and demand beginning a slow, steady recovery as those intense price pressures ease up.
So the absolutely crucial takeaway here is that the massive drop from 4.3 billion down to 2.6 billion ringgit in revenue is simply a reflection of lower, normalized selling prices compared to last year's crazy extremes. Think about it. When the price of your underlying commodity drops, your total sales revenue number is going to drop too, even if you're processing the exact same amount of beans in your factories. This isn't them losing core market share, it's really just the cocoa market finally returning to sanity.
Section 3. Are these profits sustainable?
Okay, if revenue dropped simply because commodity prices normalized, how exactly did profits go up? And more importantly for us, can management keep doing it? Stripping away the accounting jargon, management actually executed a very smart, specific financial maneuver. As cocoa prices fell, it cost them less cash to buy the raw beans they need to run their operations. They took this freed-up cash, working capital technically speaking, and strategically optimized it to aggressively pay down their short-term debt. Less debt means lower interest payments or finance costs, which directly and powerfully boosted their bottom-line profit before tax.
Look at this specific figure right from their balance sheet. By reducing their short-term loans and borrowings from roughly 2.21 billion ringgit in December down to 1.97 billion ringgit in March, they created this massive profit tailwind. But here's the catch for retail investors. You can only pay down debt so fast, right? It's not some magical, endless fountain of earnings growth. This specific maneuver to juice profits through lower finance costs is fantastic management for sure, but it is potentially a temporary boost.
Section 4. Bullish versus bearish views.
To really understand if this is a structural win that goes beyond just clever debt management, we need to look at the analyst's ledger directly from the company's notes. This side-by-side comparison impartially weighs the structural demand recovery on one hand against the very real macroeconomic and weather-related headwinds on the other. As an investor, you have to keep a cool head and weigh both sides of the scale.
Starting on the bullish side, management notes a highly positive structural shift. Remember those substitute ingredients manufacturers started using in late 2025? Well, as cocoa prices fall, chocolate makers are reformulating their recipes back to real chocolate. This guarantees a structural return of demand for GCB's processed cocoa.
the market is coming back to them. Alongside this, GCB is making a strategic, long-term expansion into the industrial chocolate segment, which carries inherently higher profit margins than just processing raw beans. That's a solid structural upgrade. Conversely, on the bearish side, we absolutely must acknowledge the stated risks in their outlook. First up, the ongoing geopolitical conflict in the Middle East is creating near-term uncertainty, which is threatening regional consumer sentiment and demand. Second, and perhaps more critically for the physical supply chain, an anticipated El Niño weather pattern is expected to severely tighten the next cocoa crop supply. If the weather ruins the crop, prices could skyrocket again, threatening to repeat the exact same painful cycle we saw in 2025.
Section 5. 3 indicators to watch.
So what should a focused retail investor do with all this information heading into the next quarter? You need to build a forward dashboard. Continuously anchor your expectations to these 3 specific indicators derived straight from the Q1 report. Number 1, watch the weather. El Niño's impact on the West African cocoa crop is paramount to GCB's raw material costs. Number 2, keep an eye on global consumer sentiment, particularly regarding how geopolitical tensions in the Middle East might dampen regional sales. And number 3, scrutinize that balance sheet next quarter. Watch their short-term borrowing levels. If they keep dropping, profits might stay elevated through lower finance costs. But if debt starts climbing again, that sweet profit tailwind might just vanish.
Ultimately, as an investor, you've got to weigh these risks yourself. Do you believe GCB's structural improvements, like their shift to higher-margin industrial chocolate and the market's return to real cocoa, will be enough to shield their bottom line from the next potential storm? Or is El Niño going to trigger another wild roller coaster? Keep those 3 indicators on your dashboard and you'll be well prepared for their next earnings release. Thanks for joining me on this explainer, and happy analyzing.